In this video, we will look at Adobe. First, we will look at their quarterly report. We will look at some of the numbers, and then we will try to come up with the fair value of Adobe stock using the discounted earnings method and the free cash flow yield method. Ultimately, we will decide if Adobe is a good purchase at this price level. So, let's get started. First of all, if you are not subscribed to the channel, you can do this by pressing the subscribe button under the video. You will not miss a single new video. Okay, the idea of researching Adobe came to me when Terry Smith, famous British investor that I follow, entered a significant position in Adobe. As we can see, after the purchase, he has around 3% of his portfolio in Adobe. And for me, it was really interesting to see what kind of fundamentals and what kind of valuation Adobe has. Terry Smith is a famous author of the book Investing for Growth, which compiles 10 years of his annual letter to shareholders. He's a long-only long-term investor, and he very rarely buys and sells stocks. So for me, it was really interesting to see what kind of fundamentals Adobe has. We are building a tool that will help us to analyze stocks and get the fair value very quickly. The data is pulled automatically from multiple sources. We can see that Adobe has 193 billion market cap. It is down around 19% for the last year. It is up 187% for the last 5 years. The average compounded annual growth rate is around 20%. Okay, if we look at the recent quarterly report, we can see that the most revenue comes from subscription-based services. So around 93% of the revenue comes from subscriptions. And the subscription revenue grew around 10% from the previous quarter. If we look further, we can see that the most revenue brings Creative Cloud. Basically, if you use Creative Cloud, you get access to programs like Adobe Illustrator, Adobe Photoshop. We can see that 57% of the revenue comes from America segment, and 27% comes from Europe, Middle East, and Africa segment. So more than half of the revenue brings America segment. If we look at some of the risk factors, we can see that among the usual suspects, like higher inflation or the impact of COVID, we know that Adobe is from technology sector and technology is changing pretty fast. As we will see in future analysis, a high growth rate is priced into the stock, and if the growth rate will be slower in coming years, it will trade at lower multiple. As a result, it may decline further in price. For example, a lot of users are using tablet devices, and if Adobe fail to adjust their business model to use tablet devices, it will hugely impact their growth rate. I know that a lot of small startups are using free software. They do not use Photoshop or Illustrator. They are using free similar software. So I see it as a major risk investing in technology companies, in Adobe particular. That is why Adobe is spending and increasing their spendings on research and development. As we can see, it is up around 10% from the previous quarter. Okay, now let's look at some of the ratios. We will look at their debt level, we will look at their growth rate, and numbers indicating their competitive advantage, their moat. Okay, if we look at some of their ratios, we can see that they have 4.7 billion in cash. We can see that they have close to 4.6 billion in debt. Debt seems not to be an issue if we consider that they have 6.8 billion of free cash flow. They don't pay a dividend. If we look at their competitive advantage, we can see that they have return on assets of 18.58%. What is return on assets? It is net income divided by assets. They have 13.5% return on equity. It is net income divided by total assets minus total liabilities. If we look at their return on invested capital, which is a metric that Terry Smith looks at when he researches his stocks, it is net income divided by equity plus debt. We can see that it is 26.18%. These numbers are indicating that Adobe definitely has a moat. If we look at their growth rate, we can see that it was from 13% to 20% for the last 5 years. The average compounded growth rate was close to 20%. Okay, so we looked at some of the ratios. we can see that debt seems not to be an issue, they don't pay a dividend, and they definitely have a moat. Now let's try to come up with a fair value of Adobe stock. First, we will use the discounted earnings per share method. We saw that the growth rate was around 15 to 20%, so analysts are projecting for the growth rate to be around 14%, so this seems reasonable. In our calculation, we will use the current price to earnings. What we basically do is we take current earnings per share, grow them using the growth rate, multiply by future price to earnings, and discount them back to today using the required rate of return of 10%. After adjusting for net debt, we get the fair value of $493 per share, which implies around 20% upside. We also need to consider that if we use lower growth rate, lower than 14%, the price to earnings will also be lower. As a result, the price will be lower because of the lower growth rate and lower price to earnings. So this is the risk of investing in high growth companies. If we use another valuation metric, which is similar to what Terry Smith uses in his analysis, if we use the free cash flow yield method, we can see that the last or current free cash flow yield is 3.9%. The free cash flow yield is next 12-month free cash flow divided by market cap. So the last is 3.9, while the average for the last 5 years is 3.17. As a result, we get the fair value from this method of 502, which implies around 21% upside. If we take the average between the two methods, we get the average fair value of $498 per share. Okay, I like the fact that Terry Smith bought the stock even at higher price, even at lower free cash flow yield. I like the fact that it has a subscription-based model. I like the fact that it definitely has a moat. If you start using Adobe products, if you learn how to use them, it is very time-consuming to learn new software. So that is why the switching costs are extremely high, and that is why Adobe has a huge moat. We also need to consider that it is a $200 billion company, and it is growing at more than 10% growth rate. So if the growth rate will be lower, the price will be much lower. So I believe this is the main risk investing in Adobe. For me, I would like to have a higher margin of safety than 20%. So I'm not a buyer at this price level. I would like to see it lower before I consider purchasing it. Also, I have made a video on which tech stocks offers the most upside potential. Here's the video. If you are not subscribed to the channel, you can do this by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.